Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're gonna see what people are sharing on Twitter, like we normally do in the mornings. I'll give and interject my opinions as we go through it. It's going to be three topics: commodities, wealth building, and/or financial topics that I'll be covering on this. And let's dive in. Let's see what people are talking about and what they are sharing. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. We do have a 5 p.m. question and answer session on Sunday for those members. So coming on down, we've got not Jerome Powell, start of the year, the Bears, and this is what they look like at the end of 2023 with the returns in the market. They look a little bit foolish. Coming on down, people have no idea what's coming in 2024. I would agree with that. A lot of people are talking about a potential recession. And let me dive in here and show you guys maybe why they are predicting that, so you kind of understand what people why they think we're going to have a potential recession. So I'm going to the 2 and 10 year, which is right here. And historically, we see slowdowns when the yield curve uninverts. And the time that we see those slowdowns is when the yield curve uninverts for a certain period of time, and then usually it's like somewhere in this rough location. I think it's down there actually. It's generally in these locations there. So right at that zero line is what they call it. I don't have a zero line here. So if this uninverts, people are calling that we could get a potential recession. Now this was inverted from stimulus money and a lot of loaning that occurred in 2020, 2021 in the real estate market. But here's the thing. We have a lot of fiscal spending going on. And fiscal spending, which is government spending, is carrying, I think, the stock market. It's inflationary. So will this uninvert? Will we get a slowdown in the market? Don't know. Um, I can say that we are primed for a potential slowdown. Because when the yield curve uninverts, that generally occurs when interest rates fall. And the government has said, not the government, the Federal Reserve has said that we could potentially have rate cuts. And now we're going to be looking to see if the short end of the curve falls faster than the long end. At this time, even though rates have fallen, we very well have kept them inverted, where they've fallen together. The 2 year and the 10 year have fallen similarly. So we've gone basically sideways for a good period of time. But it does look, here like we could potentially uninvert. Then we can look at maybe evidence of this potential recession. We look at the S&P 500. It's had a monster year from 2023 here onward. Very big year, but is this a double top? And again, I don't know with 100% certainty, but I very well could see it become a double top where this is a Batman pattern. Hello, Batman. So that's what we're looking for. We're trying to find evidence to see if the yield curve continues to uninvert, because we have a little bit of momentum here this past week, and to see if this is actually going to roll over in the S&P and or the Nasdaq, where we get a potential roll over. And I'm in the camp that we very well could. I'm not in the bullish camp. I think we are going to get a pullback. Now, here's some more data. This is the 10-year yield. Big, long, big picture view. This is your downtrend. And I think that we are in a new bull market. Well, not bull market, a new rising interest rate market, what I should say. And I think we're just getting a counter trend move in the bull market. So could a potential slowdown occur in this counter trend move? We could. Or maybe we don't get a slowdown. The yield curve stays inverted. We get a pullback to yields of about 3.3%, 3.5%, somewhere in that range. We bottom and we start to turn up. So the yield curve stays inverted. The whole curve, 2-year, 10-year drops. We drop to basic support levels, long-term support levels, which is technically a breakout and then maybe a bigger retest. And then we head on higher with interest rates. And what that will do is the lower interest rates will spark more lending in the real estate market, and that lending will cause rates to go up later on. That's I think a possible scenario. Uh, if we look at XHB, which are the home builders, we can see that that is definitely potentially a case. And I'm not saying this is just going to go straight up. We could easily pull back and do a retest of this breakout, but we're at all-time highs for XHB. And this to me looks like a Livermore accumulation cylinder, which means we could have a very big move in home builders. And I know a lot of people think that we're in some sort of housing bubble, but good luck with that approach. We can also look at KRE, which is the regional banks, and that has the same exact setup here. And I think that will eventually work its way on up. Now, I don't know the speed, and we very well could get a pullback, where it does something like that, and this is your pullback there. I don't know the path necessarily, but to me, it looks like this is an accumulation cylinder where we get a big move at the end of it. And we have a housing market deficit of homes. So that's kind of tying interest rates. Could there be a pullback and some of these stock market performance? That's kind of how I view the markets right now. It says the highest monthly closes in history of the S&P 500 and NASDAQ 100. So if math means anything to you, these are probably not downtrends. So now what he's doing is he's trying to stack information just like I do and look to see the market breadth. So we've got new all-time highs in the S&P 500. We have it in the NASDAQ 100. We have it in home builders. There's other areas too where the small caps are starting to outperform the large caps. And if we're at market top, that does seem weird, where you're getting small caps to outperform large caps. So maybe this isn't a market top, and maybe we just keep rolling higher, and we don't get a pullback. Very well could. And again, that's why I don't make predictions. I create strategies to buy what's undervalued and then hold what looks good from a charting perspective. So get a good entry point, get something that's cheap, get something that's coming into favor, that's inflecting positive, and then ride it. And just for sakes of a sector that I'm talking about, here's iron ore. Iron ore looks fantastic. It's got that same, almost accumulation cylinder. And then we've broken all this to the upside. So I'm very positive on iron ore and in steel too, but iron ore, very positive. And then iron ore is also another measuring stick kind of for dry bulk shipping because that's what gets shipped around the world the most, iron ore. And the companies themselves look absolutely excellent. Some of these base metal companies, they do a lot of iron ore, but they also do a lot of copper. And copper is looking pretty good too. So we've got a lot of really good entry points for a lot of these base metal companies, and the charts look absolutely fantastic. And some of them, they pay 8 to 10% dividend yields. So you're getting an 8 to 10% dividend yield as you're in commodities that are going up, like iron ore, for example. And if this continues to go higher, which it very well could, maybe we had the slowdown already and we're coming out of the slowdown in 2022, maybe not. I'm in a location where I get dividends and the commodity is going to go up And again, your dividend yield goes up with the commodity. You know, I think people are not realizing that if copper prices and iron ore prices go up quite substantially from entry points that we get in 2023, your dividend yields will probably double or triple or quadruple. So it's not going to be 8% in 2 or 3 or 4 years. Those dividend yields are going to go up with the commodity price, and they could go up substantially, which I like. Brace yourself for a sharp stock market decline. Quote, the experts heading into 2023, the final results. Dow's up 13, NASDAQ up 43, S&P up 24%. Listening to experts can get you burned. Keep calm and invest on. And, a lot of people are making all these different predictions. And I don't try to make predictions. I'm just trying to weather anything that's bad and get monster returns when things are good. That's that's really what I'm trying to do. And I'm trying to get enough portfolio breadth across some of these very cheap sectors to kind of balance the portfolio out a little bit. Concentration will make you rich. Diversification across a couple of different sectors, it can still do very well, but it's not going to be as quick of a grower if you concentrate into a specific sector when the sector turns. Some people prefer that, and if that's works for you, great. If it doesn't work out your in your favor, then you're going to get a very big down year. So a lot of people, I see some of the returns that people post on Twitter. Some of them are very high, over 100% or something, which is great. But I think concentration during years that um, there was no fear in the market, like there wasn't a huge advantage to take a big concentrated position like 2020. I think there is more risk doing that. So I think you've got the yield curve that's inverted, and it very well could stay inverted. We very well might not have a recession. We very well could have a recession. I understand all viewpoints, but taking a large concentrated position in a time like that, it could raise your risk level, because if you're concentrated in the wrong sector, you can get blown out. That's what I'll say there. If consumer staples are back above their late 2021 lows relative to the S&P 500, then my bet is that stocks are in a correction. So what he's saying is stocks are in a correction when XLP outperforms the S&P 500. And I think this is where a lot of people um, got surprised. And it was here, and I thought this was going to go up. I thought this was going to go up. I thought we were going to get a correction, but that reversed here in October of 2023 and headed lower. Could there be something going on in the markets where people are trying to hold the stock market up? The Federal Reserve or government, government political reasons, whatever it is. Very well could be. But I thought we were going to head higher here. We turned and headed lower. We saw that in gold in 2023 here. Gold, I think, also took a pretty good turn. Same with interest rates. So 2023, or that was 2022 there. Okay, that was back here. That was back here. So that was back here where we turned and headed higher. And we're looking for a potential turn here to head higher. And that was in October of 2022. So that's that move here. And that move went up along with consumer staples versus the S&P 500, XLP divided by SPY. So that's XLP divided by SPY. And there we are down right now. We saw a pretty good move in 2022. That's 2021 here. Okay, that's what we've got. XLP versus SPY. Yep. Coming on, we've got, we don't have a net worth tracker. If we want to estimate it, we'll add up our accounts on the fly. Just don't want it to be something we constantly look at. Are we the only ones like this? I feel like having a net worth tracker is a requirement to be on here sometimes. I do not track my net worth at all. Um, I really, I, I don't know if it's, I think I used to track it more so back a while back, but I don't really track it anymore. And I know people are like, well, I couldn't even tell you how many ounces of silver I own. I don't know what I own in platinum. I don't even know the exact ounces in gold, like the exact ounces. Some people put it in spreadsheets and they want to track everything. To me, since I just kind of accumulate when things are cheap, I just buy things when things are cheap and then I kind of accumulate it and then I don't really add it all up. Like I just buy it when things are cheap. I don't think it matters what my net worth necessarily is. I mean, I have an idea kind of where it's at. I've got, what is that? I probably have six different accounts for for brokerage accounts. Six. I've had a couple of 401ks, no, there's two for me and two for my wife who used to work at different ones. And we just left them in there because the fees are nothing. And we can buy individual stocks too. I've got a couple of individual brokerage accounts. So does she. So we've got all these different accounts, and I don't log into every single account because I don't put money in all of them all the time. I very rarely go into the ones I don't put money in, and I'm just riding the commodity bull market. So I don't add up my net worth. I don't know what all of those accounts have in it, even at this time. I have a general idea. And if someone says, well, how much are you worth? I'd be like, well, I'd have to go count it all up and then just do an estimate. So I don't know. I'm like this guy. I don't really track it with a pinpoint accuracy. I'll just say that. Um, Investors expecting a recession peaked in November 2022, and now it's down significantly. An economic downturn in 2024 would now catch most off guard. Now, here's something I want to talk about in this, percent saying recession is likely. In March of 2009, it peaked. That was after the recession. So we had a recession in 2008. It was like later '08, September, October of '08 is when things really heated up. This was after we had the recession. April of 2020 was after we had a recession. March was the big move. And November of 2022, that's probably after the move. So we might have already gone through the recession and now we're moving away from it. And the markets are forward looking. They're not they're not backward looking like people are, where something bad occurs and they're like, oh crap, it's getting so bad, and then everybody gets fearful. So these were the best time to buy stocks were in March of 2009, April of 2020, and probably November of 2022 were the best times to buy stocks. And this was the highest chance where people were saying a recession was likely. You could even see that gold bottomed at that time. It was right here, October of 2022. That would have been the best time to buy gold. And I think money's coming back into the system. Some sort of liquidity is entering the system again, which then will push things potentially higher for pricing. And then your recession will become less likely as people see and use price as a justification of their sentiment. This is how we learned nothing from 2008. This is what's going to push the housing market into a bubble. Bank of America tests no down payment mortgages for minority communities. We're going back to this. And as lending becomes easier, that is the peak of the market. And it's going to take a few years for this to work its way through. So we'll probably see a peak of the market 2025, 2026. We'll probably see the peak of commodities in 2027, 2028, because it takes about 12 to 24 months for that money to work through the system. And then we're going to go into this big blow off top in the real estate market with loaning that looks like this. That is your real estate uh, cycle. Coming down, US oil demand was at 20.68 million barrels per day in October. It's up 675,000 barrels per day, or about 3.5% year over year. Weekly estimates demand at 20.58, and the STAO report had 20.412 for the EIA. And there it is for 2023. You can see we're basically at all-time highs for demand in October. So we're at very high demand for October, very similar to what 2019 is. We're just coming up to 2019 demand, which is good. China's central bank injects a record 1.257 trillion yuan in open market operations this week for the calculation there. What does that mean? It means that they went through a gigantic real estate bubble. There's deleveraging occurring in their market, which is a real estate crash. And then almost always governments do stimulus to stimulate at the bottom of that market crash to soften the deleveraging. In the Chinese market, um, and where they're located in the real estate cycle, I would almost say that technology stocks would be the best spot to be in China. I bet they're bottoming, and I bet they're going to be a very good investment. Um, it'd be like buying stocks in 2009. And if you had chosen technology stocks like Google, Amazon in 2009, yeah, it's Google like that, yeah, Alphabet. And we can do logarithmic here. 2009 was a spot to be, guys, right there. And there's your crash. That is what the location is for Chinese tech stocks. In my opinion, Chinese tech stocks probably a good spot to be buying here over the next year, 2023, 2024. So that's where I think good opportunities are at. We can look at one. Here's Beidou. Let's get off logarithmic. So this is kind of your back and forth. It almost looks like a accumulation cylinder. 1, 2, 3, 4, 5, 6, and then you had your big deleveraging event. And here we are putting in, I think this location here is a good spot to be looking. Very, very good spot. And you could apply that across a lot of China. Okay, coming through. Here are a couple of charts showing a substantial decline in oil discoveries over time. And I don't think people keep this in the forefront of their mind. This is oil discoveries over time. Oil finds at lowest since 1952. Exploration hit rock bottom amid unprecedented spending curve. So you have to find the oil, obviously, before you produce it. And conventional oil discoveries peaked basically in the 60s, early 70s, and it's been in decline ever since. This here is going to be a major problem in the future for oil production. And I don't think people realize this. All they think about is the short term. And the majority and bulk of the growth of oil has come from shale oil in America. So I think a lot hinges on shale production for the world's oil production. If you're in the long-term camp where you just want to hold on for a period of time, like a long-term 5-10 year period, I think oil is absolutely insanely valued on the cheap side with a ton of upside potential. And if they do any sort of liquidity expansion, here's further finds. They're all the way down at 5 billion barrels of oil find. If we go back to here, 5 is like way down there. That's 5 down here. We're not finding crap, guys. In conventional oil, at least. So, but I think oil is a good opportunity. I really do. How did Chinese stocks do in 2023 relative to US stocks? They got absolutely clobbered. Absolutely clobbered. And guess what? That's where I want to be looking. I want to be looking down here. I don't want something that's up this amount. I want something that is down that will eventually put in a bottom. I want a basing pattern here. That's what I'm looking for. So, yeah, I do opposite everyone else. Here's EWZ. This is Brazil, and this thing's it's breaking out. It's ready to go, guys. You better jump on this train before this train leaves the station. That's all I'll say. It says, and there she is, the final 2023 performance of Canadian exploration production companies. The stock on this list finished the year with a median return of negative 11.32%. VET won the cup, but all things considered, TVE was the absolute worst performer. The best performer, that is one of the companies I am in, Athabasca Oil, 73%. But I do have some big positions that are also in the negative for the year. I do not trade short-term market movements, like a year-to-year market movement. I take the best companies in the world and I stay invested in them, and that does have an impact on my year-to-date performance. But I don't have a year-to-date requirement. So I stay in companies that are very good from a operational fundamental perspective. I know the commodity for natural gas is definitely not in favor, and I do have some natural gas investments, and I am buying those things that are down. So I'm buying the stuff on the right-hand side, and I'm just holding the stuff on the left-hand side. And just to let you know, the reason that these two big performers on the left here, they are making money by extracting, they're using natural gas to extract oil. And they make money off the differential of the oil price and natural gas price. That's how they went up so much. Power burn sets another monthly record in October. All 10 months are records for power burn for natural gas. You can see the blue line here in 2023. We are consuming more natural gas for power burn, for electrical generation. Now we've got inventories that are high for natural gas, and that's due to weather. It's also used for heating in the winter. But for power burn, electrical gas generation for electrical, it's at all-time highs, guys. So we are continuing to burn more and more natural gas. The demand for natural gas continues to go higher, but we also have a weather component with natural gas. And I foresee this to continue to move a lot higher going forward. We have very cheap natural gas prices, and the power burn is going to continue to go up. It's going to offset anything coal related wherever it can. Interesting to look at the rig count since January of 2019. The pattern actually looks a little bit similar to pre-COVID. But of course, the sudden drop in March of 2020 was driven by an exogenous shock. Current prices of 73 a barrel as writing of December 18th are a bit above. So this is the rig count. We had a rig count above 900 for the horizontal rig count Baker Hughes. It just fell off a cliff all the way to 2020. Then we had a very big surge higher. We've had a little bit of a pullback recently, but it looks like to me that we're bottoming. So again, I think that some of these drilling companies could look pretty good for the short term here. The stock markets are going up, liquidity's coming back into the markets, and hopefully oil can price, bottom sometime here over the next 4, 5, 6 months and start to work its way on back up. I think the rig count will do the same thing as oil price. That's what I'll think. Scrolling down, it says, what did we miss? What we missed was how much supply would grow in 2023. The U.S. looks to grow by 0.9 million barrels per day, almost a million barrels, despite the rig count falling by 20% year to date. What gives The Duke drawdown, that's the drilled uncompleted well drawdown. Privates goosing production ahead of selling, and EIA definition change explains some of the quantum. And he's got December 2022 peaks 625 for rig count. Currently, we're at 500, and about 450 to 500 rig count required to keep production flat is about the general location for flat production. And that's where we're at for rig count. And I watch rig count because I'm interested in investing in oil drilling companies. I really, really am. U.S. nat gas directed rigs flat on the week, ending 2023 at 120, down 36 rigs of 23% on the year. But to me, this looks like a bottom here. It looked like it's bottoming in October, November, December. And it looks like we're just starting to come up a little bit on the right-hand side. And this is what I look for in some of the onshore drillers and stuff like that. So yeah, we were down in 2023, but to me, it looks like we're trying to bottom for rig count. And remember, the drilled uncompleted wells, we've drawn those down. Those are pretty much gone, and we're going to have to start drilling again. So I'm positive on drillers for 2024. Junior silver miners look like they're breaking out. That looks really good of a breakout of this downtrend. That looks good. Nat gas demand, that's record for month of October. 8 of 10 months at record levels for natural gas demand. I still got the blues for you, natural gas. We got a little bit colder weather in the blue here and a little bit above warmer weather on the upper right, and average in the middle of the country. Focus on the company, not on the stock, says Peter Lynch. If you're a long-term investor, make sure the company is doing well, not the stock price. That's a wrap for uranium of 2023. It ends with most Canadian U.S. uranium mining stocks closing green. As China adds 4 more nuclear reactor builds, Diablo Canyon gets a $1.1 billion lifeline, and spot U308 hits a new 16-year high, heading into a new stellar year for uranium. And that's where I'm going to end it, guys. I'll end it right there for on the uranium. So that's looking good. Most everything's still looking good for commodities, and the overall markets continue to track higher at the current time. So give me a thumb up for the content, subscribe to the channel. Don't forget about tomorrow, Sunday. We've got that 5 p.m. Mountain Time question and answer session coming from members on the website. So we'll catch you later. This is Finding Value.